Growth in sub-Saharan Africa is projected to remain at 3.2% in 2019 and rise to 3.6% in 2020. These growth rates are lower than we envisaged in April, with growth being revised somewhat in about two-thirds of countries in the region. And this downward revision reflects the more challenging global environment and weaker than anticipated growth in South Africa in particular. Furthermore, the growth outlook remains split. There are 10 countries in the region, including the two largest economies, Nigeria and South Africa, that are expected to experience negative per capita growth rate this year. On the other hand, non-resource intensive economies in particular will continue to grow strongly at close to 6% per year, well above the average globally. Intensification of trade tensions may lower growth in key trading partners with knock-on effects in the region. We've noticed already export growth in the region has already slowed markedly, mirroring global trends. Downside risks to growth include weather-related shocks, which are becoming more frequent, and the intensification of security challenges in those areas where security challenges remain. In the short term, many countries need to implement planned fiscal adjustment to address public debt vulnerabilities. The room for supporting growth in the face of the elevated external risks remains mainly on the monetary policy side and limited to those countries where inflation pressures are subdued and growth is below potential. Countries need to raise medium-term growth to create enough jobs to employ the new entrants into labor markets and help meet the sustainable development goals. Boosting growth in the medium term will require comprehensively tackling tariff and non-tariff barriers in the context of African Continental Free Trade Agreement and implementing complementary structural reforms to boost investment and competitiveness.